So, welcome to the Sushi Forum, episode 17, where we talk about this week's news, proposals, and developments to do with the Sushi Swap ecosystem. This week we have the Arbitrum roll-up team with us to give some insight to the Arbitrum system and network because we have a proposal to put Sushi Swap on the Arbitrum testnet, basically, to start testing the waters to move to an L2 solution. And so I'm just going to get right into the proposal. Support Sushi Swap onto an Arbitrum rollup made by Crypto Navi. Unfortunately, they could not participate, but they're here in spirit. The summary is just like a short deprecated version of their write-up. Let's deploy SushiSwap on an Arbitrum rollup. First of all, what is an Arbitrum rollup? Arbitrum rollup can scale any Ethereum contract. It's the ideal scaling solution for many DeFi apps and any application which is open to public participation. Arbitrum rollup contracts enjoy the fully trustless security of the underlying blockchain, all while simultaneously increasing the dApp's capacity and greatly reducing costs. And motivation. It is clear that L2 solutions are a necessary upgrade, and as this should not require much effort from our dev team, I believe the benefits far outweigh any effort spent bringing this to life, even if only on the testnet for now. Additionally, Arbitrum is powered by Chainlink nodes, therefore I expect we would see a wave of additional support and lasting loyalty for SushiSwap from the Link Marines if this proposal moves forward. So yeah, this proposal is basically to deploy SushiSwap in its current form onto the Arbitrum sort of EVM rollup system. Would you guys want to give us a little bit better background as to the origins of Arbitrum and where it is currently and where you guys are taking it?
Yeah, be happy to. So I mean, I think Arbitrum is actually Arbitrum was originally thought up by one of our co-founders, Ed Felton, who's a Princeton professor, before Ethereum had actually launched, which is kind of wild. And then he went off to he got recruited to join the Obama White House for a while, so he disappeared and the whole thing got dropped, and we picked it back up a few years ago now. Um, we picked it back up essentially back when the only two types of scaling were plasma and state channels. And I had a lot of really annoying conversations with people trying to convince me that there was no other type of scaling possible, that all Ethereum scaling was either plasma or state channels. And then rollups became a thing. And so kind of we've been our off-chain labs, which is kind of the company that's like actively working on building Arbitrum. We kind of were founded and raised a seed round led by Pantera Capital back in the beginning of 2018. And 2018, is that right? 2019, I think. My dates always get away from me. And so we've been working on it for quite a while now. Arbitrum Rollup is the only rollup of any kind that has a public testnet that is capable of running EVM smart contracts. And so that's kind of the biggest thing right now, is actually sort of being able to have sort of rollup style scaling without sort of breaking compatibility. So no custom compiler, support for Solidity, for Viper, for whatever you want, and as seamless as an experience as possible. So I'll stop there, but happy to talk about anything that's of interest.
Yeah. For one, so my understanding of rollups is, and this is a very basic understanding, but is it's essentially almost like a compression protocol for the EVM.
The way I like to describe it is that basically that there's kind of there are two different sort of parts of executing a blockchain, and normally they're combined. And those two parts are sort of transaction ordering and transaction execution. And on Ethereum, those kind of go hand in hand. Rollups split those up. And so you still have the sort of transaction ordering and availability layer fully based in Ethereum security. But what you do is you take all of the execution, which is the expensive part. And when people are complaining about Ethereum scaling, it's never sort of, oh, we can't fit the transactions in our blocks. It's, oh, state growth, oh, gas, all of that stuff. And that's what rollups can bring off chain. And the only difference between basically optimistic rollups and ZK rollups is how they actually ensure that the execution occurring off chain is actually correct.
Okay, gotcha. And when you say how the difference there is that like I think what I read was that like optimistic rollups do it in a single like check or something like
Oh
that, and
yeah,
then
yeah. So
yeah, go ahead.
the big difference is basically, so there's the big divide, which is sort of optimistic versus ZK, and then there's kind of some variation within optimistic rollups. So the big divide is fraud proofs versus validity proofs. And that's where kind of you have ZK rollups that have validity proofs. And so there they come and they say, hey, here's the execution, here's the result of the execution, and here's a succinct proof that execution was done correctly. And you can immediately know that it was correct, which is amazing, but unfortunately quite limited because it's dependent on a lot of quite heavy cryptography. And there are also associated with it a lot of hard to know because this hasn't really been deployed, but very expensive off-chain proving costs in order to generate this extremely fancy cryptography. Optimistic rollups are much, much simpler. Basically, in an optimistic rollup, you have someone proposes and claims, hey, this execution was correct, and they put down a bond. And after that, there's a window during which anybody can come forward and say, hey, that was incorrect. And it's kind of, there needs to be a window because you need to allow time for somebody to come forward. Because we don't know it's valid necessarily when it's initially posted. And for that, then the question is, how do you prove fraud? And kind of the technique we use in Arbitrum is actually kind of very related to, if anybody's heard of kind of quite an old project called TrueBit, you'll kind of hear some familiarities here. Kind of a bisection protocol where we take the entirety of the disagreement and we cut it into smaller and smaller pieces until we have kind of a minimal size piece over the course of sort of a number of rounds of back and forth. And at that point, we just run it on chain and see what the result is. And kind of the other technique that's used for optimistic rollups is the one that Optimism is using, which is sort of to just rerun the entirety of the transaction on chain. And the way I like to describe sort of our variant of optimistic rollup is it's extra optimistic. It's extremely optimistic. And what I mean by that is that in the happy case where there is no dispute, there is an absolutely minimal amount of stuff going on chain, which means that our costs can basically be lower than anybody else in the happy case. Because sort of we instead shove off a bunch of the complexity into the challenge in kind of a place where it will never really occur in practice, at least without someone malicious losing large amounts of funds.
All right, gotcha. And so for security, like, because you have basically node operators for optimistic, or do you have like
Oh yeah,
validators? No.
yeah. So it's totally permissionless. Basically, anyone can see an assertion being made about kind of a claim of what execution did occur. And at that point, anybody is able to issue a challenge who's willing to put down a bond. And so there's kind of a bond requirement set for the chain, which is the amount you need to put down to challenge to kind of eliminate nuisance and make sure that it's incentive compatible. And as long as you're willing to put that down, then you're allowed to participate fully in the system. And that's kind of very necessary since the security property we want to maintain is basically is essentially as long as there is somebody who's honest and cares about ensuring that the system runs correctly, then it will. And there are basically kind of two key parts to that. One is this sort of permissionlessness that anybody can challenge, and the other is having a reasonably long challenge window in order to ensure that someone notices and has time, and to kind of maximally protect against things like censorship attacks. And I could definitely refer people to Vitalik has done a lot of very interesting writing about sort of how to kind of think about this, and I think has been quite supportive of sort of the configurations that both us and Optimism have been looking at here.
I'm curious on what is the waiting period for Arbitrum?
Yeah, absolutely. So it's not fully locked in yet for our main net, but currently we're targeting a 7-day window. We originally were targeting a shorter window. The history behind this is kind of interesting. It basically comes down to how much you kind of view it as a risk that there's a 51% attack on Ethereum for kind of some amount of time that blocks all fraud proofs. And kind of and so the idea behind the week is that then there will be time for kind of a hard fork in order to slash everyone who is doing that censoring. If it weren't for that, it could be shorter, and it's kind of a community discussion basically where the right amount of window is. One really important thing to note here is that the 7-day window is not one that will generally be experienced by users for sort of two reasons. One is that this is really only a kind of a limit on sort of communication from the layer 2 to the layer 1. And so sort of everyone instantly knows, or kind of not instantly, but everyone very, very rapidly knows what the final state is on the L2 system. The only thing that kind of happens at a delay is the actual withdrawals or the actual communication between the layer 2 chain and the layer 1 chain going through. And the other thing basically to know is that there's kind of a number of different projects. I think the two announced ones so far are Connext and Hop, who are building, and I would really call them layer 3 solutions for allowing for fast withdrawals in order to move between chains, in order to sort of make the movement of funds basically seamless. And they do this in really cool trustless ways, basically by having sort of a liquidity provider front you the money ahead of time. So let's say I want to withdraw 5 ETH from the chain. I go to the liquidity provider. I give them a small fee. They give me ETH on L1, and I give them the rights to my withdrawal when it completes. And so kind of the normal user experience will kind of look much more like that and happen very quickly rather than kind of actually waiting for this waiting period.
So when we have that, is there because obviously the person on layer 1 has to pay a fee. So how does that work without how do you integrate the different pieces between the 2 layers or in the 3 layers if you have the liquidity provider on layer 1?
Not entirely sure I understand the question. So I mean the idea here would basically be you pay a fee to the liquidity provider. They get your funds, they get your withdrawal after the week, and they are willing to front you the amount that you're withdrawing minus their fee very quickly because they have a secure guarantee that your withdrawal will go through in a week. In terms of sort of beyond that, basically, I mean, I'm not entirely sure I understand the rest of the question. If there is more.
Yeah, I guess how is it that the layer 2 is communicating with the third party, And I like in my mind, part of why that's confusing is because it feels like there would then need to be twice as many gas fees because they need to send, the liquidity provider needs to send to the person who gets it, and you need to get from layer two to from the layer two to the layer one, which I'm unaware if that costs the same mean that
Absolutely.
Ethereum gas costs.
Yeah, so I am by no means an expert here, and kind of one very cool thing is that like the Connects team and the Hop team basically came to us and said, "Hey, we have solutions. These are not things that we developed, but I do kind of understand well enough to give sort of a small description, which should hopefully help. And they use two very different approaches. Connext basically uses kind of their existing state channel network, and so basically what you're doing is you have a cross-chain state channel between the L2 chain and the L1 chain. And so kind of using their channels, you transmit your funds across. And so sort of there, basically, you're in a world where there is no withdrawal happening even. You just sort of put some money into the channel on one side, you have a liquidity provider with funds in the channel on the other, on the Ethereum side who you're connected to, and you do that swap. The Hop approach is instead basically much more sort of much more AMM like, I would say, in that they actually have sort of a pool where you could trade sort of L1 assets and L2 assets against each other directly. And then sort of the navigation between layer one and layer two only happens kind of when that pool needs to be rebalanced. And so the common element on both of these is basically that the withdrawals kind of most of the action occurs in layer two, and kind of the layer two chain and the layer one chain only need to sort of interact a small amount, and most of the time you're sort of just someone is providing you funds on layer one in exchange for funds on layer two. And so what that'll look like concretely is sort of, you know, an escrow transaction or a deposit transaction on layer two, and then probably either kind of a withdrawal from a state channel or just or kind of a withdrawal from a smart contract where there are funds available on layer one. And so sort of withdrawing is not the cheapest thing ever. You're not going to want to do it a ton, but it'll be quick and it will not be sort of extremely expensive. It'll be sort of at a reasonable target gas price.
It's pretty interesting. Is the L3 sort of solution that you're talking about, is that sort of like, are they officially partnered with Arbitrum, or are they aiming for like sort of a bridge between all the different L2?
Yeah, both Hop and Connect are targeting all of the L2s as much as possible. I mean, I would say I think I don't want to be wrong here, but I think this is correct that Hop is sort of mainly focused on EVM supporting L2s. So I know they have a demo set up where you can kind of directly transfer funds between, for example, an Optimism chain and an Arbitrum chain. Connect, I think, is a bit more general in terms of what they can support because state channels are kind of a much more sort of general construction. And so I think I would guess that they will also be supporting kind of ZK rollups along with all the optimistic rollups.
Gotcha. Did anybody who was listening in have any questions or thoughts that they wanted to bring up? It's totally an open forum. Yeah. Theo, did you want to say something? Okay, I don't know. They were activating the mic.
One thing I might add, this is AJ from Off-Chain Labs, just sort of the way we view the ecosystem developing, the end user is not, going to be looking to go in and out of the, out of Arbitrum back to layer one as the ecosystem develops. We view it more as a bootstrapping problem, but, as Harry mentioned, we're trying to build the ecosystem within Arbitrum where ultimately that's where the end user, is going to want to be. Just compared to some of the ZK rollup context where you go in for a trade and you exit again. So it's a little bit of a different dynamic. I just wanted to raise that to the group.
I guess one question I have is just what if like you guys built or Uniswap built this version on Arbitrum and it was just my understanding is very bare bones. Whatever happened with that and why was it kind of abandoned?
So that was not in participation with Uniswap. That was basically just us having fun and taking the open source contracts and deploying them on Arbitrum. So it wasn't abandoned. It's kind of one of the many pieces of software that are deployed on our testnet currently. Some of which we did ourselves, other of which have been done by companies or organizations that came to us and said, "Hey, we deployed our contracts and we added them to the list of people deployed on Arbitrum."
Yeah, and if you'd like to see the full list, it's at portal.arbitrum.io. There's a number of projects there that are building on Arbitrum, and they're going to have a demo up on the testnet soon. Will be coming to mainnet with us as well.
Yeah, sorry, what was that URL?
Sorry, yeah, portal.arbitrum.io. Is there a good channel for me to post it here, or like a chat?
I threw it in the general chat.
Okay, perfect.
Yeah, thank you for that.
So I had a question. Is there you talked about that like layer 3 thing. Is there any way on the roadmap for people to interact from Arbitrum or from a layer 2 with some of the layer 1 DeFi protocols indirectly? I don't know. It's just how possible is that for the future?
Yeah, it's a great question. It's one that we've kind of been spending a lot of time thinking about. It's very case by case, I would say. I think that I would expect sort of all of the DeFi protocols to be involved with L2 one way or another, because essentially, I think a lot of them are certainly not going to wholesale migrate. A lot of them are going to have sort of like an L2 either independent component or sort of like connected component. But essentially, like it's going to be not having some way of hooking into L2 is basically just not viable if the gas costs are like 1% of what they are in L1, unless you're talking about sort of super high value settlement. And kind of the approaches that different projects have taken are really interesting. I think one of the kind of one of the ones I find particularly interesting is as an example is Augur, where basically kind of they're keeping rep on L1, they're keeping sort of their main core, all of their sort of core infrastructure on L1, but they're allowing kind of individual markets to move into L2. And kind of still relying on the layer 1 for settlement. And I think ENS is kind of doing something similar where they're kind of going to be allowing for delegation of names to kind of to go to addresses in L2. So I think it's kind of case by case, but I find it basically impossible that we're not going to be in a world where sort of everybody's doing something to sort of make themselves accessible. But it is hard because basically that 1 week delay for sort of fungible assets, we can paper over it. But for sort of more complex interactions, it's kind of much less easy to get around, and kind of we're very actively sort of exploring design patterns of basically how people can work within those limitations.
Different question. Sorry if other people have stuff, just like flash your mute button so I don't take up all the time. But I had curiosity on like, there's all these cryptos that have given out their incentives to like draw early on. How are people going to get incentivized to move over other than lower gas fees? It would seem like I know that HoneySwap, for instance, really struggled with getting proper liquidity on their exchange. How do you see that playing out in the future?
Yeah. I mean, I would say it's a great question. I mean, it's kind of there's a couple different parts of this problem. There's kind of why are projects moving and why are users moving. Why I think for projects, the gas fees, at least from our experience, have tended to be enough to get them, really interested. Like saying, the gas costs on your users could be 1% of what they are right now is, pretty appealing. But obviously, kind of that's not everything, and there's sort of hurdles to overcome with layer 2, and kind of I think in a lot of situations, you're just going to have sort of very similar dynamics playing out today. So a project will move on to layer 2, and they'll do liquidity mining in order to incentivize migration of liquidity to layer 2, and sort of a lot of the same tools basically will be used there. So kind of we don't really have plans of doing this sort of ourselves, but I think that a lot of people deploying on us basically have plans to do it, and I think that sort of it'll be a lot harder to pull. It'll be a lot easier to pull people into L2 as gas prices rise. Those those fees that are just sort of making people not use Ethereum when you open up MetaMask and you see that it's going to cost you $100 to interact with some smart contract are a pretty damn good incentive to make the move.
Yeah, hey, I'm Fred from Off-Chain Labs as well, and it's not just a hypothetical like price decrease. We already ran the numbers, and if people are curious, we have actually tested it out. And for example, if you want to make a deposit, you're able to go 100,000 gas on the layer 1 cost all the way down to 2,000.
Yeah, I don't think Fred made it totally clear just now. This is basically like, after the proposal went up, one thing we really like to do is basically just like jump into people's open source code and throw it up on Arbitrum. And so those are numbers from like the Sushi contracts actually like deployed on the testnet already, which is pretty cool.
I like it. I don't know, Joseph, if you're listening in or had any thoughts on this as a potential. It'd be great to get your opinion.
Sure. Yeah, we've been doing research on this, since I started. I have a protocols background, so this is obviously the thing that interested me most when we coming to Sushi. We are looking at L2 scaling solutions, although I think that we've excluded optimistic rollups from that and are opting for a ZK solution. Those are for the reasons that I detailed in the forum. Is that kind of like the challenge period present a problem for our withdrawers, that even with bonded LPs, we kind of break the composition of cross contract calls in between L1 and L2. And we really would like to maintain that composability. So I think what we're looking at right now are ZK rollup solutions that include EVM support, barring some opcodes, of course. So looking at Starknet, which is an EVM offering from Starkware, and ZK Sync has a yet to be named EVM support protocol coming soon.
Gotcha. So it's like you see primarily the 7-day lockup and withdraw that breaks the composability of certain type of tokens.
But yeah, like I'd like to be able to trade from L1 into L2 and settle in L1, and have some sort of like interesting asynchronous design patterns for trading. But really, my thoughts are around liquidity, and our liquidity is our most valuable asset. And if we kind of send it to L2 early, like we are now, I mean, I know that L2 is coming this year, like almost everything will be in L2 before the end of the year. But if we send it too early, we fragment our liquidity and introduce like higher price impacts on some of these pools. Yeah, that's kind of like what I'm thinking about mostly.
I would agree with a lot of that. I'd love to like add like a little kind of color and perspective, because I mean I feel like I agree with a lot of the facts there, but I would argue kind of for a very different outcome from those. I would say the one fact I would argue with is I'm still deeply dubious of ZK rollups that are capable of sort of general EVM actually being doable on mainnet at low cost within the next number of years. It's really, really hard. The proof generation is really, really expensive. And the technical risk of sort of the cryptography involved is really high. So I mean, I'm not gonna, you've probably done more research than me on this, but I would take a lot of that with a grain of salt until it's actually here, compared to sort of optimistic rollups, which are just fundamentally much simpler. The other, but sort of like the problems you identify though with sort of optimistic rollups, 100%, absolutely. Totally agreed with those. And ZK rollups don't have those problems by and large, if you can deploy on them. What I would say is kind of they bring composability in a different way, and optimistic rollups have much better composability in a different way, which is sort of within the L2. The fact that kind of, yes, interacting with the L1 is great, but as the sort of migration advances and kind of more and more moves into L2, having kind of the standard normal synchronous composability with everything else on, let's say, the Arbitrum chain with you becomes very valuable. The other thing I would add is basically, and this is, kind of, not exactly technical, but in terms of liquidity strategy, I think one thing that a lot of people have found quite interesting is basically the idea of sort of layer two to attract retail DeFi. So sort of low value trades that are currently totally priced out of the L1. And the interesting thing there is that basically you could take, if you take sort of quite a small fraction of your L1 liquidity, even with trades kind of generating a decent amount of slippage on L2, they'll still be much better for your users because the gas fees will be so much lower.
So doesn't Starknet require using Cairo instead? I thought it was not EVM compatible.
Starknet is going to be their EVM offering. Right now, what they're offering is Cairo. And that's going to be like the language that they base their EVM implementation on top of.
Okay, thanks. Makes sense.
Any other questions or thoughts from anybody listening in? Egon, could you mute your microphone, please?
I guess I was curious, is there going to be any fees to migrate onto Arbitrum, like from like how there's a XDAI 0.05% on the way out?
So there are not going to be any sort of percentage fees like that. I think there is likely to be sort of a small per transaction fee in gas, but sort of on the order of, I think kind of on the order of basically your transaction is so much cheaper in gas than the layer one, and the layer two fee will be sort of quite a small increase on that. So basically it'll be entirely independent of sort of how much is being traded, and it'll be small enough that sort of it won't really impact the decision of whether it's cost effective or not at all.
13.
And did you guys think you had any sort of idea of the roadmap in terms of when you think mainnet might be, or sort of the terms of progress on the audits that are ongoing right now?
Yeah. I mean, so we're still hoping for during March. It's kind of security is the most important thing for us, because the transition to optimistic rollups and to rollups in general is just incredibly critical for the Ethereum ecosystem, and we want to do it right. So we're not going to kind of make any firm commitments to launch timeline until we kind of have those clean bills of health. But I could say we're feeling pretty optimistic about March.
Awesome. Just in time for the anniversary of last crash. Unless anybody else has any questions, I think I'm gonna wrap up the Arbitrum discussion there. I want to thank the Arbitrum team a ton for coming out and answering our questions and being here. You totally didn't have to do that, but I mean, it was super, super nice of you, and I appreciate it.
Hey, thanks for having us.
Yeah, I'm going to basically be covering this past week's news for Sushi. So if you guys want to stick around, you can, or if you guys want to head out because you guys are busy doing developer stuff, I totally understand. But so this week for the Sushinomics section, the price of sushi. This might be out of date now, but at time of writing, somebody has their microphone. Hey, Theolog, could you mute your microphone?
I didn't know that.
Okay. So yeah, sushi is at $13.97 when I was writing this earlier, down at 12% versus Bitcoin over the past 7 days. But the 24-hour trading volume is up about 23% over the past 7 days. In terms of news and development, Cream Finance added 6 SLP tokens as supported assets. They announced this last week, and it went live yesterday or the day before. And the LP tokens they added are WBTC ETH, DAI ETH, USDC ETH, ETH USDT, Sushi ETH, and YFI ETH. And when you're using that as collateral, you're also earning sushi on top that basically automatically gets put into the sushi bar. And then when you withdraw your collateral, you get the X sushi back, which is very awesome, very good for capital efficiency. And then moving on, we have Yearn Finance rotating their maximum sushi allocation to the YVE Curve ETH LP pool, which is basically the LP pairing for ETH and the Yearn Curve Vault. If you're interested in how that Yearn Curve Vault works, I would look at Andre's Twitter. I think he has posted or retweeted several things recently that goes into that. But basically, it's a high earning stable coin vault, to put it simply. The sushi rewards on that pool is over 250% right now for ROI. It's pretty huge. And then we also had the feeds sushi quote. Oh, go ahead. Sorry.
I just wanted to add there had been recent news in the past 24 hours of, I wasn't sure if it was that pool, but it was one of the, they had to shut down one of the Yearn pools that involved, it was one of the Y Vault pools, and I don't know if it all impacted that, but
was it
yeah,
the V1 die pool or vault?
No, that was the first exploit 4 days ago.
Oh, there's another one?
This was another one last night while I was sleeping last night. I haven't fully read up on it.
Okay, well.
So
I don't know what to
let's
say
not
about
derail the conversation since neither of us know about it.
No worries. Yeah.
It was the Yearn, like it's the cream tokens. It's the Y pool. YV2 pool, something like that.
Oh, is that why the I don't know if this is related, but I saw that the Aave pool on Curve was giving like 3,000 or like over 1,000, couple thousand% APY, which made me feel like there was probably liquidity that was somehow withdrawn.
I don't think it's the same pool, but yeah, it's the pool that's like supposed to be lending from the Iron Bank, but it's under the Wire front end, so it's called Y something.
Okay,
Anyway.
gotcha. So
Shouldn't
but
back.
it's not the YVE Curve pool though.
Yeah, that might be this one.
Oh, it is that one. Okay, well, until we have further information about whatever exploit happened on Yearn, be wary, do your own research. In other news, feeds.sushiquote.finance is live for SushiSwap, which is basically Andre's little keeper bot system that has an oracle system for the price, volatility, and then it automatically gives you the options pricing using realized volatility in the Black-Scholes equation, which is just it's like a purely theoretical pricing model. You shouldn't actually, at least from everything I've read, it can backfire very hard if you're using that as your actual pricing model. I don't know if you had any thoughts on that, Orion.
Not really.
Gotcha. But yeah, Mark Cuban has revealed that he owns Aave, Sushi, ETH, BTC, and LTC, Litecoin. It sounds so weird to say LTC. I don't know why. But yeah, Mark Cuban's sort of gone on a crypto spree lately, and somebody even purchased a video of him talking about Sushi Swap, which was quite funny to watch. Good publicity. And we have Ren Doge also added to the onsen. It's currently at a ROI of 64%. Get your Doge on in the onsen. And Gnosis Safe has announced a new grant for integrating SushiSwap features, functions into the Gnosis platform with a grant of $6,000. And I think it's coupled with maybe like Cream and something else. It's great to get more integrations with SushiSwap. I was looking at it, and I don't know if it's like, I'm not a developer, so I have no idea, but $6,000 seemed, for the amount of work they were asking, was almost seemed a little bit short. But I don't know if they have it like where you can it's basically all almost already done, and it's just simple, and they're just trying to get some community engagement there. I'm not sure. We had a DeFi dollar AMA in the SushiSwap Discord on February 5th. You can catch a recap of all the questions asked on I think I tweeted out from my Twitter account, and I'll post something in the description. And we have a Sushi X 88 MPH AMA scheduled for February 11th at 6 p.m. UTC. So if you want to ask any questions, be sure to show up. That's all I've got written down for news. Was there anything else that you think I missed, Orion, or anybody else that is hanging out?
There is something that last week we had a pretty full episode with all the devs on, so I didn't feel I had a chance to ask it. I was just curious on what we're doing, because we had that a couple of weeks ago. We had that like dig air where with the new coin, someone was able to siphon the X sushi stuff, and I was just curious if like what is being done to stop that, and do we have people like monitoring new releases and stuff? was just something I had for the sushi team.
Yeah, it was an oversight on our part. And the losers in that essentially are you know, ex sushi holders. And yeah, it's an oversight on our part. So as we're adding these onsen pools, we're gonna make sure that we have like kind of a good routing table for it.
And the issue was like simply a portion or half of the fees for the Badger pool were basically being absorbed by some LP in a very low liquidity pool.
Yeah, they're getting hit by like basically price impact in a low liquidity pool. And so that's why kind of like defining the routes is important, for so that we kind of like don't, as we're swapping these LPs out for for sushi, it's important that we do that in a route that doesn't have a high price impact.
Gotcha, yeah. And also I just thought of this. Somebody asked in the Discord what is going to happen at the end of this current onsen period. Like, will teams have to reapply to be on the onsen? How sort of like what does that process look like?
We're working on like so some of it we're gonna continue to kind of have be like this incentives program, but like in a way where it's kind of like kind of like hand picked kind of thing. But for the most part, we're moving towards a strategy where we can incentivize onsen based on statistics. So I use this in our team meeting. I use this as uh, uh, I use the analogy of Moneyball. Right now, we're for onsen, we're incentivizing it on kind of like ones and twos and making like subjective judgments about like what would be interesting, what we should bring, and instead we should opt for a statistical model that kind of like tells us um, what pairs are going to give us the best kind of volume to liquidity ratio, and incentivize those pairs. So I think we don't have any like numbers wrapped around it yet, but like I think like something probably like a 90-10 split, where 90% of the onsen rewards are going to kind of like these some sort of time weighted average based on volume to liquidity for individual pairs, and the other 10 being split for kind of like on a like a hand picked basis.
Gotcha. That's exciting. And is that sort of is that going to be working sort of on chain as like an automated system, or is that more of, regardless of how the data is collected, as long as it's legitimate data, it's going to be sort of looked at and managed by team members?
Yeah, it's too big of a query to be doing it on chain. So and then like also kind of defining that is a little murky. So we're gonna do it as a like kind of a graph query, and we're gonna get results and kind of like maybe host like a leaderboard or something to show kind of like
Mhm.
where the different pairs are. And this is going to be kind of like outward looking as well. So we're going to be wanting to attract liquidity, the best pairs with volume to liquidity ratio, in the ecosystem.
Awesome. Okay, that's pretty exciting. Um, you got anything else, Orion? I think
Yeah.
yeah, go ahead.
There were a few things. So now in SushiSwap.fi, we can swap and go directly to XSushi, like from ETH XSushi. And I was curious, on where, like, I noticed that we don't have any pairs on ours. I know that, for instance, Bao has some X sushi liquidity. Is that where we're sourcing all of that pool, or where does the liquidity come from?
I'm sorry, I didn't quite catch the question. You're asking about a Bao sushi pair?
Well, no, I'm talking about the pair. So now when I go through Sushi Swap, I can swap directly from ETH to X Sushi. And I didn't see any X Sushi on anywhere on our onsen or any of our menu, but I know Bao does it. Is that where we're sourcing all of our liquidity for, or is there other sources of liquidity for the X Sushi that shows up?
You're talking about like in just a general swap, right?
Yeah, just in the swap feature of SushiSwap.fi.
Okay. So that is using a wrapper. So the way that we make X sushi is like it's always a fixed, well, not a fixed price, but it's a floating price that is explicitly convertible from sushi to X sushi. So if I want to go from sushi to X sushi, there's an exchange rate, and that exchange rate is based on the amount of sushi that's held by the X sushi contract, and the amount of X sushi that have been minted, right? So if I want to mint it, like right now, the exchange ratio is around like 1.16, something like that. And so if I want to mint an X sushi, I can mint an X sushi by sending 1.16 sushi to that contract. Does that make sense?
Yeah, that's actually how I was hoping that it was working. And I was trying. This came up because I was like trying to help other night one of my exes like get into sushi and get it staked, and gas was high, so I was like trying to like, oh, is it worth it for me to go in X sushi? And then I was like afraid that she was gonna get hit with some price slippage because I didn't know where the liquidity went, which brings up my second question: is why in our current form isn't slippage or like price impact or the route shown? Like that
Or
just left me some confusion.
for going from LPs to sushi, is that what you're talking about? Because like let me just say, like in clearer terms, we collect fees for for the X sushi pool as LP tokens. Those are the fees, the 0.05% fee that's carved off of each swap, then are given to the X sushi contract. And the X sushi contract has an X sushi minter. It has a pool of sushi that's inaccessible until you destroy an X sushi. And then it also has a pool of LP tokens. And when you call a serve it up function, it basically unwraps and trades those into sushi. And so there's essentially like on the X sushi to sushi, there's zero price impact and zero slippage. There is one minor consideration of if there are a lot of LPs sitting in this kind of like pool that haven't been processed yet, an attacker can go and borrow a bunch of sushi, go get a larger share of the X sushi pool by depositing their sushi and getting X sushi, and then calling the serve it up function and getting like kind of like like a week's worth of fees in like a few seconds, and then withdrawing and then returning. And so like it was like an attack that profits approximately like $100 to $300 in sushi.
Very interesting. Cool. Yeah, kind of like with the seniorage coins. I remember you could stake them last second and get the full rewards. But so the
exactly the same scenario, exact same attack, right? Yeah.
So the second part of my question, I don't think you quite got, was just in the new UI, when you go to the swap part, it doesn't show you price impact and it doesn't show you the routing that the trade goes through. And I was curious why you chose to eliminate those.
For which one?
When I go to the left bar on sushiswap.fi and I click on swap,
Okay, and then you swap, and then what are you missing here?
So normally when I go to that screen, before I hit do the details for it, it will show you like what the price impact is for, say I'm trading 50 ETH for sushi. I'd be able to see what the price impact was. And or say I'm going from Bitcoin to sushi, I'd be able to see that it's going the WBTC ETH pair to the sushi ETH pair. Like you get to see the route, and it no longer shows that.
Ah, I see, I see. It must be a direct route. So if you're these only appear if it's a hop route. So like if I have to go into one pool then another. So if it's a direct route where it's just this pool to it's like one pool of ETH sushi, it's showing you the route for ETH sushi.
So yeah, then the question is just like, why did you get rid of the price impact? Because it's just something that I like to know, especially if I'm dealing with a low liquidity pool.
Oh, I'm looking at it right now. It shows price impact when you type it in.
Well then I stand corrected.
Oh, well, if price impact left, that would be a big problem though. So like, yeah, I would definitely want to know. Because, you can get wrecked. I've seen people get wrecked for, 50 ETH on a price impact because they were kind of like not really paying attention.
Yeah, I've almost got wrecked by slippage as well. I didn't, but I almost did.
Yeah.
I've done it to myself on HoneySwap. You'll only do it once though, and then you learn.
So on DeFi Saver, they kind of like they're not really like super communicative about the slippage when you're doing a boost, and I don't like that.
DeFi, I don't understand how much money you have to make DeFi Saver like actually like worth it. Like
Oh,
it's so
yeah.
gas inefficient and just like I don't know.
So let me put some insight into that. They say $4,000 like crypto value, like USDC value of the crypto, and that's true, because like you're probably hitting the method buttons and you're hitting boost, and it's like $250 in gas to boost up,
Yeah.
right?
Yes.
And like that can, for like a $4,000 portfolio, that's 1/16 of the portfolio in gas. Like what? That's crazy. But one, to take into consideration that that's like kind of like a per like case basis, but also that when you enable automation, there are gas savings that they do it because they do it as a group. So like MakerDAO's like price feed is like every hour they do liquidations, right? Or they give a price that you can liquidate against. So DeFi Saver, what they do is like you set automation and it gives you a window of like your lower bound and your upper bound. And they kind of like have a bot that fights essentially a gas war for you to boost up your portfolio or boost down your portfolio to prevent you from getting liquidated. It's a very sophisticated system, but when you're paying for gas as a group, it's much better.
I see. But I think the limit or the minimum amount on the automation is, I don't know, maybe 100,000, or maybe I'm misremembering that.
It's like 4,000 USD value, uh, and to open a Maker Vault, you have to have 500 DAI value, I think.
Yeah, I don't know, because at the very beginning of sort of DeFi, I was layering and leveraging using Maker Vaults like manually, and it wasn't as expensive as doing it all in one step as DeFi Saver. Like DeFi Saver is like great to look at for charts and to track my position and stuff, but I don't know, it's super expensive.
I guess it's kind of for that peace of mind that you want to make sure you'll never be liquidated, since DeFi Saver manages your.
Yeah, if you're
Like
going
Joseph's,
with the
yeah.
automation feature, yeah, for sure.
Oh
'Cause
man,
honest-
but it's so good though, right? If you think about it, like when the price is going up, this thing is sitting there boosting you up. to like as the price is going up, you're getting more and more of ETH or whatever is underlying, or WBTC. But when it's falling, it's also delevering for you. So it's kind of like this log curve of a window, so that you can kind of like, if you start with a low amount, you'll wind up with a high amount.
And if you were doing the boost strategy since the bottom in earlier this year, like the return was just crazy compared to just holding your ETH. Like they have a simulation on their website. You can do the simulation, and it's just like it's really worth it. But for me, it's really just the peace of mind of knowing that, because I don't want to check out my CDP every hour to make sure I'm not getting liquidated. So
What do you mean? You don't want to be in constant financial stress at all hour?
yeah.
Oh my gosh, I had some friends at this like last huge crash that got zero bid liquidations of their DAI vault. So yeah, I was like, when somebody mentioned that I should get this, I was like, took that very seriously.
Yeah, I don't think the people in DeFi Saver got zeroed in March 12th. Well, you'd think so.
All right. Unless anybody has any other topics that they wanted to bring up as the last topic, I think this is sort of serving as a good point to call it. Yeah, okay. Awesome. Well, thank you everybody who came out and participated this week. Next week we are going to be doing it 3 hours earlier, to try to better accommodate European people. So hopefully that works. Joseph, thanks for coming out, and everybody from the Arbitrum team. I again really appreciate it. It was super cool. Yeah. Have a good week, guys. Stay safe.
Thanks.
Many blessings.